This Lunch and Learn today is really, really special for me because I get to share with you my co-host, Karla Dennis. Karla is CEO of the consultancy firm Cohesive, has saved her clients and myself thousands of dollars, and has been featured in various media and outlets such as Forbes, MSNBC, KTLA, Yahoo Finance, Smart Money, and it's making her as they mark her as the ultimate tax expert, and I know for a fact personally she's amazing with taxes. And as of January 2013, Karla joined me as my co-host on my radio show, so it's been a real honor to have her side by side with me, and we've been having a lot of fun. She shares a lot of her financial and business knowledge with Greater Los Angeles area and Orange County, so it is without further ado that we're going to have some really special information as it relates to the 2014 tax things happening.
Thank you so much, Tony.
Karla Dennis.
If you're a business owner or individual, all of us are going to be affected a little bit. So education is power, and once you have knowledge, then you have to act on that knowledge, right? To do something positive. So that's what we're going to be doing today, and I think we're going to get started here. All righty, so let's go. So what's going to happen with the healthcare bill? The aim of the healthcare bill is to make sure that everyone has the ability to get affordable healthcare. Be it right, be it wrong, that's the law, and that's what's happening as we move forward 2014 and 2015. Larger companies are going to have to provide their employees with health care if they're full-time employees, and over 50 employees, larger companies will have to provide health care for their employees. A lot of companies have already started laying off people or not, taking people down from full-time care to about 38 hours a week, 35 hours a week, so they don't have to get hit with that. So that's what's going to be happening in 2015. Uninsured individuals, anyone who does not currently have medical insurance, is supposed to pick up medical insurance through the Covered California, or however you choose to get that. You're now required to have medical insurance. One of the things that becomes very interesting is how are we going to police the fact as to whether or not an individual has medical insurance, right? How is that really going to get policed? It's going to get policed through your tax returns. So we as tax professionals now are required to ask our taxpayers, do you have medical insurance? And we now have to fill out about 3 additional forms that are coming. They will be in the 8,000 series of forms that are now going to be coming. So a lot of us have been in classes, taken education, and really trying to get it figured out so we can get it figured out for you, the taxpayers. So there's going to be a lot going on with that. So who is going to be affected by this law? Pretty much everybody is going to be affected by the law. Whether you're an individual needing to pick up health care, whether you are a corporation needing to get health care for your employees, everybody is affected by the law. Those employers that have less than 50 employees do not have to provide health care, but still the individuals have to go out and get health care from some fashion, whether it be through another carrier, through their spouse, or whether they pick up health care on their own. They're now required to have that health care. So what happens in 2014? In order for, in 2014, that mandate to come up, it starts in 2014 for them to get that health care coverage. If you do not get that health care coverage, you're going to be penalized as an individual. The penalty as an individual is going to be $95 a year, paid with your tax return, or 1% of your income, whichever is greater. Okay? So that's going to be happening when we get ready to file our tax returns. In addition to that, there's also going to be the advanced premium tax credits. This is real important because I want everyone to know about this. The advanced premium tax credits are credits that you're going to get on your tax return. So part of the theory is if we're going to go out, the government's going to go out and say you got to get health care, you got to pay for it. Part of what they're doing is also extending to you a credit on your tax return. Do you guys know what a credit is? Okay, I want to make sure you know, because a credit is different from a deduction. A credit is dollar for dollar. So if you're going out, for example, and you may have to get health care that healthcare may cost you $500. Perhaps on your tax return, you may get a $400 credit to kind of be money back in your pocket to kind of offset that on an annual basis. Are you with me on that? So it has its pros and it has its cons, but I'm sure some of your tax preparers are not going to know about that. So I want you to make sure that you guys know you should get a healthcare credit on your return.
And it's dollar for the full amount?
No, it's going to be a percentage of the full amount. It's never dollar for dollar with our IRS, right?
That wouldn't make any sense.
Right, it's going to be a percentage, but at least it's definitely going to be something out there, yes.
I know that when you apply and you call insurers, they will give you an estimated
Yes.
Amount at this point. Does that mean that the premium per month will be reduced and that will apply the credit?
No, absolutely not. What you're talking about is that when you apply, there's some calculators out there where you can kind of calculate what your tax credit is going to be. You still have to pay the full amount of the premium, and then on the tax return is where the credit is going to apply. Okay? That's very important, and it's going to be a refundable credit. So if individuals who normally don't file tax returns because maybe their income is at a certain amount but they have to pay for their health care, they will now want to file tax returns to make sure that credit is applied so that they can take advantage of that. Okay, are you guys with me on that? Yes.
Are you holding questions to the end, or we can ask them?
Ask your question.
So, this advanced premium thing is what you're talking about.
Yes.
Who defines low to middle income?
Mm-hmm.
What's that number?
The government defines low to mid
So it's
income.
like $25,000 is middle, right?
Not exactly.
Right,
They're
of course
still
not.
coming out with those tables. Like to this very now, we don't have the hard numbers. As a matter of fact, IRS has delayed tax filing by 2 weeks. So we're not even going to be able to file tax returns until like January 28th, when normally we're able to do it by January 15th. Just because those numbers and all the forms have not been clearly defined.
But we're being asked to opt for a program between now and the 23rd.
I totally understand. I totally understand. That's exactly correct. You are being asked to opt for a program, but it's not definitive.
Okay, so my second half of that question is that premium, tax credit, whatever, does that apply for if I'm on my husband? Or
Yes.
if it's- Okay.
Yes, it does apply. Absolutely. So when you file a joint tax return, you're going to see that credit. Yes.
Do you know exactly how many hours per week an employee has to work to be considered full-time?
Full-time is 40 hours per week. Mm-hmm. Absolutely.
That's why Trader Joe's is cutting people back.
Yeah, there's a lot of companies out there, and I know this is very upsetting for a lot of people, but I just want to make sure that you guys understand what the rules are so that you will understand how to apply the rules and you don't miss out on any opportunities to get the tax credits. I mean, we can be here forever going back and forth on the right and the wrong, but education is what I want you to have. Yes.
So we were talking about poverty level, but also on the other end, is there a maximum that you can't exceed for income where you wouldn't get credit back from the government?
Absolutely, there's a maximum. I believe the maximum is like 76,000.
Oh, it is that high?
Mm-hmm.
Oh,
Where
oh.
you
For
wouldn't
a
get
family of how many though?
if you wouldn't get a credit for family of 4. I think it's around 76,000. But again, those tables are
That's the poverty
still
level here.
those tables are still being adjusted. Okay, just so you know. Okay, I'm gonna move forward because I have a lot of information to cover, but I do know we have another question, and I'll try to take that at the end. Okay. All right, so let's kind of move forward. It's a lot going on with this law, but you know, this is not new. We've had a lot of laws. This is just a law that affects a lot of people, and it's kind of an emotional thing. We've had a lot of laws where things have not been clearly defined. So we are going to be anticipating a major tax law change in 2014. I am certain in 2014 there's probably going to be some adjustments here and there, but we got to go with what we know right now. Okay, for small businesses who do provide their employees medical care, they can get a 50% credit up to the amount of the premiums for small business owners. So for example, if you are an individual who has their own company, their own corporation, and you're able to get like a group plan, don't forget that you can get a 50% credit against your tax bill for having that medical plan, even if it's your personal medical plan. So I want to make sure you understand that, okay? So there's definitely some options out there in terms of that. All right. The Affordable Care Act taxes, they're going to directly affect the average American. That's just what's going to happen here. There's going to be additional tax on health savings account, Medicare savings accounts, medical savings accounts. If that information or that expense is not deductible, there's going to be additional taxes levied because you put too much money in or what you paid out of it was not proper. So that is also going to be an effect for taxpayers. The amount of the flexible spending account caps have been adjusted up a little bit, so that's going to be helpful for taxpayers. The other item that's
Adjusted which direction?
up,
Oh.
so you can have a larger flexible spending account.
Because it was 2,500 for the
Right.
last 2 years, I think.
Exactly, so
how
that
much do
has
we have now?
been increased up to $3,500.
Fantastic.
Okay, the medical deduction threshold. This is one that's an interesting one. In order for you to take your medical deductions, we all know we have to get over 7.5% of our adjusted gross income, right? Now it's 10%. So that has increased. In order for you to take your medical expenses, it has to be more than 10% now of your adjusted gross income. So that's definitely a change that is happening. Advanced premiums and tax credits for individuals and families, kind of what I told you about. I'm anticipating, and this is some things that are going on in terms of the Senate and the House right now. A lot of what is happening right now is that we have a lot of bills that are kind of being drafted and a lot of conversation going on, which I try to keep up with that. One of the things that they're talking about for a lot of what they call low-income families is to give them an advance credit like they did the Earned Income tax credit. Okay, they're talking about advancing the credit to them. That's going to be interesting to see how that kind of pans out. But that is definitely on the table, not defined yet, but that could possibly happen as well. Okay, so the individual mandate starts in 2014. As many of you know, it's been all over the news. This is when it's going to happen, in 2014. So,
Will you explain what the individual mandate is? So
exactly. The individual mandate is that everybody come January 1 is supposed to have health insurance. Come January 1, everybody is supposed to get their health insurance. Either through your own employer, go out and purchase it for yourself, through your spouse's employer. Jan 1, we're supposed to all have health insurance. Do I think that that's going to happen? Probably not. Do I think there's going to be some modifications to this law? I think so. But then again, we'll see what happens when the law comes out, right? So let's continue. Alrighty, most people will have their insurance or will pay a penalty if they don't have the insurance. Maybe for some people it's worth paying the penalty. If the penalty is $95 a year or 1% of your income and you just can't afford it, is it worth you paying the penalty? Perhaps. Those are the decisions that are going to be made at tax time and things for you to talk to your tax professionals about and kind of figure it out. I know that a lot of people are talking about they'll just rather pay the penalty. So that's exactly what the penalty is going to be. The maximum penalty will be $2,085 per household, or 2% of your income. Okay? So just some good information for you to know, but there are the tax credits that are going to be out there in terms of the Affordable Care Act. Please do not allow yourself not to pick up those health care credits on your tax return. And the reason why I say that is because these forms are going to come out late in the tax season. If some of the forms have not been released, and we've had seasons like that where tax forms are released maybe even 15 days later than the filing season has started. And if you file your tax returns early, you may miss out on those benefits. So you just want to definitely be aware of that and how that's going to affect you. So what else is happening with the healthcare bill? We also have the 3.8% increase in tax on unearned income. And what is unearned income? Unearned income includes capital gains income, passive income on rentals. That's what unearned income is. So there are going to be some caveats to that in terms of the dollar amount. So I will tell you, on a capital gains, unless your gain is over $300,000, you won't have to pay that 3.8% on capital gains dollars. Are you guys with me on that?
Have you already excluded the 500 or the 250, 500?
This is on, not talking about a primary residence. This is just on a capital gain on your rental property. Primary residents are not gonna get hit with this. They've excluded primary resident property.
When you mentioned 3.8 though, and what was the cap on that? What was the max?
The 3.8
Yeah, what was
on
the
passive income, unearned income,
unearned income?
it's also gonna include capital gains income.
Right.
And if it's capital gains income, if your gain is over 300,000, the 3.8% applies going all the way back to $1.
Okay, under, you won't be affected.
Correct.
How about if it's is there a distinction between long-term
No.
capital gains and short?
No, there's no distinction yet.
Is
Okay?
that per year?
It's per transaction. You know what I mean? So within the year, absolutely. So if you're in 1 year and you're under 300,000 for capital gains for that particular year, you're under. Okay?
That doesn't apply to rental income, does it?
Yes,
Specifically.
it does apply to rental income specifically. Absolutely. Unearned income. Any income that we're not going to pay self-employment tax on. It does apply to that.
But over $300,000.
That's correct. Okay. Now, in terms of this 3.8%, it does not apply to the primary residents. Like I said, they're going to definitely exclude that, which is great, finally. So what can you do really about this whole additional amount of taxes that are going to come in? You know, anything is subject to change, as Tony says, anything is subject to change at any given time. Whenever there is lemons, where's the lemonade in that equation? A lot of this that is happening, it's happening, whether we choose for it to happen or not. But what's the positive side of what is happening? What can we do as taxpayers to put ourselves in a better position? And that's really what I want you to understand. Are we going to be paying some additional taxes? Maybe, perhaps. Can we reduce those additional taxes? Absolutely, we can. We just have to be a little bit more diligent about our expenses, making certain that we're capturing everything and really keeping track of our paperwork. A lot of us think, oh, you know, I had that meal, no big deal, we tossed that receipt, or I had that medical expense, I won't get over the 10% threshold, so we start to toss our receipts. This is going to be a year that we need to really pay attention to what it is that we're doing with our receipts and really focusing on our tax situation, okay? So let me give you some examples of things that you have to be thinking about. Tax strategy is going to be extremely, extremely important. Regardless of where you are, the dollar amount that you make, 2014 is going to affect us, and everybody is going to need to think about their taxes from a totally different perspective. You need to really strategize, get in front of your professionals and say to them, what do I need to be looking out for? I will tell you that there are several strategies to mitigate a lot of the effects of what's going to happen with this healthcare bill. But these are things that you got to get in place prior to filing your tax return. So there are 3 pillars to a tax strategy, and I'm going to go over those pillars with you so that you can understand what does that really look like when we talk about strategy. And let's say, for example, everybody in here is either an individual wage earner, they have a business. You guys plan to come to this seminar today. Thank you very much for being here. But you had a strategy for getting here. You put this on your calendar, you thought about it, you registered, you came. You had a strategy. That's the same way you have to think about your tax situation. If you know you're going to be affected, don't put your head in the sand. Let's get it figured out and figure out what we need to do. So the 3 pillars of a tax strategy is that we really have to kind of review where have you been in the past. We need to assess your current situation. And then we need to come up with the right strategy. And not just come up with it, but get it implemented. We really need to become doers and thinkers in 2014 and empower ourselves to do more. Okay? So I'm going to walk you through what that actually needs to look like. Okay? So my first question is, what's the difference between a referee and a coach? Anybody? Before I start calling on people, because I know the names of some of the people in this room.
One tells you to do, this is what you're going to do. The other one said, that's what you just did.
Okay.
So it's a before and versus an after.
Okay, I like that. Could somebody add to that? Yes.
I would say one teaches you the rules and one penalizes you for breaking the rules.
Okay, very good. One teaches you the rules and one penalizes you for breaking the rules. Okay, what else? Yes.
One tells you what you can do and one
Right. Okay. Very good. So in my opinion, a referee is that person that's always dropping those flags like in a football game, making us all crazy, right? And he knows all the rules. The coach has to know the rules. He has to know the rule book, but the coach also has to be able to think outside the box and really educate their teammates and really get them to go where they need to go, right? That's what a coach is for. I mean, coaches here in California, we just had that USC coach change, right? Coaches are fired overnight in California for not getting the job done. So you want to make certain that the coach is the person that's going to tell you, this is the rule, but let me tell you this little trick and how this works in real practice. Those of us that are in real estate, for example, there's people that are out there to try to sell their own homes, and they try to follow this little rule book, but every realtor knows there's so much more to it than that, right? So this is the type of stuff that I want you to understand. So a coach strategizes with his teammates. So in terms of strategy, someone has to be sitting down with you and strategizing. I do a lot of education in terms of taxes. I know I'm a weirdo. I read the tax code for fun, but that's what I love to do, to read the tax code. So I can understand what's in front of my clients and what they're gonna, you're laughing, but I really do. What's in front of my clients and what needs to happen, okay? If we don't know, if we're uneducated, what ends up happening when we don't know something?
Get hit in the head.
We get hit in the head, we get paid, we get penalized, we pay for something higher, right? So we got to strategize. Just like us ladies get on the internet, at least I know I do. I get on the internet and I'm looking for deals all the time, right? We strategize for that shopping. This is the stuff that you have to do with your taxes. You got to strategize. You can't just have your hand in the sand. All right. So the first part is review the past. Your tax person and you need to sit down and review your past situation. What is it that you've done in the past? And that's critical. Some of you may not think that's critical, but that's extremely critical for your tax person or whomever you're working with to understand your past history. And I'm going to give you some examples of why that's critical. If a brand new client were to come to me for taxes, I want to look at their past tax return. Maybe they had some losses that are carried forward. Maybe they have some credits that they were not able to take. There's a lot that goes on. For me to understand that is going to be very helpful in terms of where we need to go next for you. So if you kind of think about it, if you were going in to see a doctor, would you want the doctor just to prescribe you medication without knowing what your past history has been or your past prescriptions have been? I mean, they don't get it right all the time anyway, right? But we certainly want them to look at the past and kind of know what's happening. And that's what needs to happen in your situation. Then the very next thing is assess the current situation. Where are you right now? You don't need to answer this question, but I will just say to you, do you know what your 2013 tax liability is going to be? I know the answer to that question. I want to know the answer to that question because I want to know, am I overpaid? Am I underpaid? I will never be overpaid, I'll tell you that much. I mean, they're only going to get exactly what they're going to get from me, but I want to know where I am. It's important to know where we are. A lot of us don't want to know. We don't even want to know come April 15th. But if we know, then if we know better, we can do better, right? So you want to know where you are on your 2013 tax bill. It's not a hard thing to figure out. That's extremely important. Once we know where we are with our tax bill, then what can we do?
Go forward.
Go forward. What else?
Look for where you can save.
Look for where you can save. Exactly. What'd you say?
Make adjustments.
You can make adjustments. If we know where we are, we can make adjustments. That is so important. So if you're looking at your taxes in April 15 for 2013, can you make adjustments in April 2014 for your taxes in 2013? Can you? Not many. All the adjustments need to be made in the current tax year. So once you know exactly where you are, we calculate where you're going to be, what your tax liability is going to be. Now, game on. You have an opportunity to reduce your tax bill. You have the opportunity to implement the right strategies. And there are a lot of strategies out there. How many of you know how many pages are in the U.S. tax code? Any guesses?
6,000.
You said 6,000? Okay. How many did you say? 30,000, okay. Any other takers? 15,000, okay. Anybody else? Over 80,000.
read all of those?
And I continue to read them and reread them.
Okay.
Yes, there's over 80,000 pages in the U.S. tax code. So if there's 80,000 pages in the U.S. tax code, do you think there's a couple of pages in that code that may help you as an individual taxpayer or as a business owner? Of course there are. But a lot of your tax professionals don't talk to you about the tax law. They mostly talk to you about tax compliance, filling out the forms. That's different from tax law and figuring out the code that's going to help you reduce your tax bill. Now we have the tax code, which is over 80,000 pages. And then after the tax code, we have Treasury regulations that explain the tax code. How many pages do you think that is? Any takers?
200,000.
200,000, anybody else? Nobody wants to say anything? How many?
150,000.
150,000? I truly don't know, to be honest. You guys should Google that. How many pages are in the U.S. Treasury regulations? I don't know, but it's a lot. I'll tell you that. And then after that comes case law. So there's so many things that are out there that can help you reduce your taxes. It will actually blow your mind. Now, I know a lot of times we hear that some of our people that make a ton of money in this country, for example, I remember the year they were talking about Mitt Romney and the fact that he only paid 15%, he was in a 15% tax bracket. Do you think he was in a 15% tax bracket legally or illegally? Totally legally, right? So as a tax person, I'm sitting back thinking, wow, he must have a great tax team to put him in that tax bracket. The only difference probably between him and all of us is probably the zeros behind his income, but the tax code is the same for everybody. Are you guys with me?
Yeah.
Okay, so it's extremely important. So what is
Not
some...
a good talking point if they don't try and stick it to them.
I know, right? So what are some things that we could do? All of us, if we're business owners, we should be certainly thinking about writing off our cars. If you are a W-2 wage earner and you're in the pursuit of employment, you can still write off your vehicles. Okay? If you're a W-2 wage earner and you're in the pursuit of employment, you can still write off the utilization of your car. That's important for you to know. So at least that's something that we need to be looking at. Okay? Also, there's travel and entertainment. You should be writing off your travel and entertainment if you're a business owner. Can you write off any travel and entertainment if you're just a W-2 wage earner? Who said no? No? What if you were out and you were networking to look for a job? Could that be a job? Could that be a job hunting expense?
Yes.
Absolutely. And I will tell you, IRS has been very lenient, believe it or not, in this area through this new normal that we have in this economy, because a lot of people were laid off of their jobs, and a lot of people are networking now, going out and talking to people and showing up at all of these meet and greets and all these different events to try to procure employment. So that could be a write-off for you even if you are a W-2 wage earner. Yes?
What about home businesses? Are they still cracking down on home businesses, or are we more lenient?
There was a time IRS used to crack down on home-based businesses, and really it kind of had to deal with a lot of the people in the construction industry. But I will say they're not necessarily sticking to home-based businesses. I think that if you have a home-based business, take every write-off that you can. If you have a brick and mortar business, you can still have a home office like I do. Because I will tell you, work doesn't stop at 5 o'clock for me. I mean, I'm always on my internet and checking and looking. So take advantage of that. Don't be afraid to take your write-offs. A lot of people are afraid to take their write-offs because they're worried about an audit. They're worried about an audit. And maybe rightfully so, but don't be worried about an audit. The government's going to do their job. They have to do their job. If they found $10 of income that you didn't report, do you think they would make you report it? Absolutely. So take all of your legal expenses that you can. Okay? All right. Some other things really quickly. If you're in a position where you're selling some real estate and you have a gain and you're not interested in purchasing more real estate, we have what's called a deferred sales trust out there that's been very beneficial for taxpayers. This is just another way to help you save on your taxes and keep some of your money in your pocket. Okay? And that's just kind of for talking points if you're in that position.
Can you just go back to one slide, please? Home parties.
Mm-hmm.
So if you have a dinner party and it's business, you invite people that you do referrals with or whatever.
That's a
And
write-off for
receipts?
you. That's exactly correct. Keep all of your receipts. People are doing a lot more entertaining. We had gotten away from that a little bit, I think. But now the more face-to-face interaction and entertaining is coming back. Definitely.
And does it have to be every single person at the table?
No, because you're gonna have spouses, friends, and things that are gonna come. But really, in order to get a write-off, here's the catch. It has to be because you were trying to do business. Just link it to business. Okay? I have a client right now that I just finished up an audit, literally. Just finished up an audit for this particular client. He was working with another CPA, came to me to help him with this audit he got into. They have a yacht that they own, and they took the yacht as a write-off on their tax return. And it was a pretty huge write-off, and the IRS auditor disallowed it. So in talking with the auditor, I linked the yacht. I said, you know what, this lady does high-end homes, Coda de Casa type of people. These people have yachts. This is part of her presence. She wants to do business with people that are like her, and they want to do business with her because she lives that type of lifestyle. We got that yacht written off. So you just have to link it to business, okay? All right, other things you can do. Vanessa. Oh, look at that, Vanessa, I brought it back. Other things that you can do if you have children, for example, and you have a business, you can put your kids on payroll, give them a job description. These children are a lot smarter than we think they are. They definitely are high tech in that social media world. They can get your cell phones up and going. They can do a lot for you. Get your kids on payroll. Shift income off of your income tax return and your tax bracket, shift it over to your kids' tax bracket. The beautiful thing about putting your kids on payroll is what?
You keep the money under the house.
You keep the money in the family. What else?
You take it off of yours.
Yes? Anybody else?
You pay them and get the money.
Wait, you pay them and keep the money? My kids would never let that happen, trust me.
Mine either.
You could fire them, right? You can fire your kids. If your kids don't do what you tell them, you can fire them. They get very, very diligent about their money, okay? So those are different things that you can kind of do. And I put down here, pay for daughter's wedding. This is literally a true story. I had a client out of New York. They had rental property. They were in a situation, and they came to me because some of their rental properties were underwater where they owed more to the bank. They felt like they had been overpaying taxes and they couldn't get it figured out. They had an interior design business and they had to pay for their daughter's wedding. How many of you believe that fathers should pay for daughters' weddings? No? Is that not the new law?
It's not a lot.
It's not a law?
In my culture, it depends if what subsection.
Oh, it's culture? Okay.
Yeah.
Well, in my culture, I want the fathers to pay for the daughters' weddings because I have 4 sons, okay? So that's what's going to happen in my culture. We're just going to make that happen. All right. So in this particular case, the father wanted to pay for his daughter's wedding. I said, we need to get your daughter working for your business. She came in as a photographer. She did photos, put together a great web page for them. We got the daughter paid. She paid for her own wedding, got the taxpayers a tax deduction. So you just got to start thinking outside the box on things that you can do.
So, I'm sorry. Oh, so you put that in the bank account then?
Put what in the bank account?
The money for the photography or whatever.
She was paid on a W-2, and she did whatever she chose to do for it. It was earmarked for her wedding. Okay? So there's all kind of strategies behind real estate. I think you guys probably know that. If you own real estate, great. If you don't, you should, because it's an excellent place to be. I want to go through some cases with you. These are actual cases of clients in my office where we had a W-2 wage earner. They also were a real estate investor. They had a couple of kids. Their tax bill was $48,000. After we did planning with them, we dropped their tax bill by 10 grand. That's a lot of money to me. It could be 5 grand. It's your money, right? You have to decide, do you want to keep your money in your pocket or do you want to give it to Uncle Sam? It's legal to reduce your tax bill. A lot of times people will come in and say, you know what, Karla, I got this income over here that I don't want to report, blah, blah, blah. I'm like, report all of your income get a strategy in place. The law is there to help you really if you understand a little bit of it. Okay? That's a huge, huge savings for that client. Huge savings. Okay? We had another case, W-2 wage earner. This was a small business owner. They had a mortgage. Their tax bill was $23,000. After they did tax planning, we reduced the tax bill down to $14,000. That was a savings of $8,100. Okay? So you have to kind of decide what you want to do with your money. So the next question, in my opinion, is when is strategy important? When do you think sitting down with a tax professional who knows tax law is important? Anybody?
For the tax bill.
Before what?
The tax bill arrives.
Before the tax bill arrives? Absolutely. What else?
Probably every year.
Every year?
Before the end of the year?
Before the end of the year, right?
As soon as possible.
As soon as possible. Those are all good answers. But I want to tell you, strategy is important all the time when your money's moving. If you're getting ready to buy a piece of real estate, and if there's a way that you can buy that real estate and get a great tax write-off, and you find that information before you go buy the real estate, it's better for you to have had that conversation prior to buying the real estate, right? There's so many things that if you're getting involved and your money's moving throughout the year, that you need to be having conversations with your tax professionals. So I'm just going to go through a few of them: buying real estate, doing business in multiple states, making money, selling property, looking to increase your wealth. We got to get the tax bill down, okay? Pulling money from an IRA. A lot of people rated their IRAs when the economy wasn't doing very well. They rated their retirement plans. There were certain ways that you could have rated your retirement plans and not get hit with a penalty, okay? So all of these are important. Incorporating, looking for investors, trying to increase revenue in your business, looking to decrease expenses, and also if you're looking to do self-directing with your IRAs, it's important. It is important all the time. As you're going through life and life is happening, it is important that you're talking to someone. And it happens throughout the year. It doesn't just happen because the government said from January to April 15th, it's tax time. That's just the time that they put down and said we have to file our tax returns. But tax strategy is all the time. It's when you're getting married, right? To vet out those spouses' tax returns. It's when, unfortunately, some people are going through divorce. There's a lot of issues there. If you need a short sale property, if you're buying property, there's a lot going on in our worlds where we need to be having that bigger conversation so that we can do things the right way, okay? Very, very important. Okay, so we're at the end of the day. It is literally the fourth quarter of 2013. It is literally the fourth quarter of 2013. I will tell you a little story about this picture. Number 25 is my son, and they were at the state championship for football, high school football, which is really big down in Orange County. And the game was tied literally 7-7, and we were going against our biggest rival for the state championship. The coach huddled the kids together, and they had the ball, of course, right? The worst scenario possible. They huddled the kids together, and the coach told my son, you got to pick that ball and run. Just so happened he has very fast wheels. He's ran for me from all of his life, so he's gotten a little faster. He has very fast feet. He picked that ball and ran it back for a touchdown, and we won that state championship. But the coach stopped and put that strategy in place. You have to think about that. You have to stop right before you finalize that shopping, whatever it is you're doing for the holidays, right? And really put some time into thinking about your taxes. Because I guarantee you, if you spend some time with your taxes, you will have a lower tax bill. That's for certain. Okay? So I want you to know that. I also have a special offer for you, a couple of things. If you guys would visit Virtual Karla, that's virtualkarla.com. I'm not sure what's on there. That's a Vanessa question. But if you write it down, you'll have it. virtualkarla.com. I will give you a complimentary tax consultation, and I think that you will get educated and learn a few things if you walk through that website. It's not intimidating. You answer a few questions and you will get back some really good education. I think that's extremely important for you to have. I also have another offer for you. I have a CD. I do a lot of speaking. I do a lot of writing. I do a lot of education. And I think it's important because I don't think that taxpayers know enough about what they need to know in order to get a lower tax bill. So I do a lot of education. I have 7 of my most purchased CDs on this CD here. I normally charge $19.95 for that. For Tony and her people and you guys coming out, it'll be $10 if you want to pick this up. You can see Vanessa, my right-hand person, in the back of the room. It's educational. It will tell you things like, how are you leaving money on the table? How many of you are leaving Uncle Sam a tip? Do you know? Okay, maybe you are, maybe you aren't, but you can find out about leaving Uncle Sam a tip. 7 things that you must know before filing your tax returns, how to have a better conversation with your tax professionals, just good education. So if you want to pick that up, feel free. And I am going to close it out with this. My name is Karla Dennis. It is always, always a pleasure for me to speak with anybody who doesn't fall asleep when I'm having a tax conversation. I appreciate you guys being here today. Tony, thank you very much for allowing me to come out to educate. And I'll stick around for a few minutes if you guys have some individual questions, okay? Thank you so much.
Out loud, like for the evening, would you like to ask questions?
Questions so that everybody can get the benefit of it.
You want me to try to figure out how to turn this back on? Let's see if I can make that happen.
Can we ask a question?
Yes.
Out loud? Okay, so does the individual mandate apply for seniors?
Yes.
And how is that done? Through
The exact
California thing? Or
The exact same way. The individual mandate applies for seniors, and if these are individuals that have never filed a tax return, they will want to file a tax return just so they can have whatever it is they're paying for their medical, whether it's Medicare, Part A, B, however that's done, they can entitle to a credit as well to offset that, okay?
Given the unpredictable nature of real estate agents' income, not knowing 1 month to the next what there's going to be, and applying for Covered California, they're asking you, I assume it's considered an estimate. When I've called around to the insurance providers, they've indicated to me, just call it an estimate. So I've used income sources that I've got, and then interest and so forth from accounts, but yet, how are we, and our 2 questions, how can we anticipate what our next year will be based on the unpredictable nature of what we do? And in addition, we're going to have to pay the full pop premium for that policy we opt for, and then wait till the end of the year to get that back?
Absolutely. So your question is twofold. So his question is if you're, and it's not just with real estate, if you're self-employed basically, with real estate agents or any other type of self-employment, we don't have guarantees on what our income is going to be. We can give it our best guess based on our last 6 months, our best history, or whatever the case, but I kind of look at that as a little bit of a loophole in the law, right? Because you just have to have a reasonable basis for figuring things out. My reasonable basis, I would look at a period of 3 months and I would take my worst 3 months. And that's what I would use. And I would have a valid basis for doing that. Because IRS says that you can average and come up with a reasonable basis, especially when people are self-employed. I've used that on other issues with IRS.
Now, with respect to the insurance aspect, if they're expecting folks to pay this stuff up front, they're trying to get people who have simply avoided the system entirely because they don't want to give a dime. They don't want to. They don't have any money.
Right.
And if they're to be expected to pay the full price, even though there's a supplement that's going to bring it down to a very low level, where are they supposed to get that money? I mean, if you get a premium for $450, and that's what these are, the full price. Of course. And then after, if you're making no money, or you're making $15,000, $17,000, I think there's a certain point where you pay nothing. What is it, like $15,500 or something?
About $15,500.
And then you're expected to pay all that when you don't have it.
Right.
How are you going to come up with the money initially, even if you're going to get it back?
Right. I totally understand, and those are a lot of the issues and a lot of the problems, if you will, or things that are gonna have to be sorted out. I don't want to say they're problems, but they're just things that haven't been thought through well yet. But they're gonna have to come up with some solutions for that because you have people in those situations. Yes.
Now, say if you have life insurance, but you want to take the cash value of life insurance, is that taxable?
Well, it depends. If you want to take your cash value of your life insurance, for sure the growth is going to be taxable to you if you pull it out of your life policy. That's absolutely correct. Yes.
You were showing one of the tax shelters, or you were saying formation of different things, and an LLC was one of them. If you have an LLC and then you haven't bought properties and put them into the LLC, you thought you were going to, but didn't, and now you want to not have your LLC, do you just not renew it, or how do you?
You formally close it. You formally dissolve it. Because
and if you don't, then you get hit with the $800.
that's exactly correct. You're going to get hit with the $800, and then when people Google your name, it's going to come up defunct company and all of that. And California is really big on making sure that they get their $800 if it's a California LLC. Yes.
Well, I can answer the life insurance question on that. That's what I specialize in. As long as you're doing loans. Like
Right. Right. If you do a loan, that's right. It's not taxable. But you pull out cash, it's taxable. Yeah. Yes.
Could you clarify, my understanding was with the extra Medicare tax that there was a 0.9% for earned income and 3.8 on investments. What is that? You said investments was 300, I assume net, so that's sort of considering wash sales, considering all that trade. What is the earned income?
200,000.
200, okay.
That's right.
Is that that's
For that 0.9 that you're talking about, that's another little piece outside of the 3.8.
Right, and it's, and both of them would go back to $1.
Yeah. Yeah.
And that's for an
So
So
one needs to balance
make
at the end
sure
of the year.
that you don't
Like
get to that.
analysis.
Yes, that's important.
Yeah.
Was that for an individual or for married couple?
That's for an individual. Married couple, 250.
So
Yeah, there's a lot going on with it. So it's so many different thresholds for each individual tax. There's different threshold amounts. So you have to be very careful not to just assume that this is across the board.
going back to what you said about get your kids on the payroll, at what point does a kid have to file taxes, not just for that, but say they earn $2,000 in that, and then they earn babysitting money. That's cash.
Right. So the law says that if you earn $1, that you may have to report it on your tax return, right? But will you have to pay tax? No, because it's going to be under the standard deduction. So you can pay minor children up to $6,000 a year, minor meaning they're 17 and below, and there's not going to be any tax on their withholdings in terms of Social Security or Medicare or anything like that, nor will they need to pay any income tax. Okay?
So what if my daughter earns babysitting money for?
Technically, by the letter of the law, it should be reported.
And up to what dollar amount?
There's no
before
limit.
she has to start paying taxes.
If she goes over $6,000.
So $6,000 from me and $6,000 from babysitting.
No, total of $6,000. If your daughter has a total income of $6,000, she's going to pay tax. Anything over $6,000, she will pay. But you got to kind of think about it. Is she going to pay in a lower tax bracket? Maybe it's worth your kids paying in a lower tax bracket than the tax bracket you're in. I'll give you some examples. Some individuals, realtors, different people in different professions, if your income is over certain thresholds, you cannot carry your children as exemptions, or maybe you can't even get some of the educational credits that are out there for kids and different things. So it becomes smarter to even pay your children even more money, let the tax be generated, and let the credits wipe it out. So you just got to kind of look at every situation differently based on their situation. It's just no cookie cutter answer across the board. Yes.
So this is the first time I've actually heard someone say the difference between a credit and a deduction, which kind of blew my mind because I was thinking about them in the same way. So a credit is obviously better.
Right.
But I guess you also said there's different ways to figure it. It's not, even though it is sort of dollar for dollar, it's
Right.
not really.
So you want to always vet it out, because there are some things out there you can take a deduction or you can take the credit for it. So you want to figure out what's best for you. If you have a tax liability, most likely getting a credit is going to be better. If you don't have the tax liability and getting a credit is not going to be good,
Right.
take the deduction, get a net operating loss, and use it in another year. So there's so many things out there. I will just tell you that for every single situation, there's probably an answer. You just got to kind of get it sorted and figure it out. But it's just very important that you get it sorted and get it figured
So
out.
it sounds like you're allergic to your clients paying taxes.
I am allergic to my clients paying
I
taxes.
like that.
I break out in the hives,
Good,
okay?
because I better get in hives when I write that check.
Yeah, exactly, right? All right, it's been my pleasure.
Thank
You guys
you
take
so
great
much.
care, okay?